Most people don't think of buying a car as a financial decision. They think of it as a practical one. You need to get to work. You need to move your family around. You find something you can afford the monthly payment on, you sign the paperwork, and you drive away. But that monthly payment framing is exactly where the trap begins. Car loans are one of the most common forms of consumer debt in the world, and they're also one of the most misunderstood, not because people don't know they're borrowing money, but because the way the loan is structured makes it very easy to end up paying far more than you planned for a vehicle that's worth far less than you owe, sometimes for years. This isn't bad luck. It's how the system works. Walk into a dealership, and the first question you'll often hear isn't, "How much do you want to spend?" It's, "What can you afford per month?" That shift in framing is not accidental. When you think in monthly payments instead of total cost, you lose track of the actual number. A $600 monthly payment sounds manageable, but $600 a month over 72 months is $43,200 before interest. Add interest, and the total climbs further. The car you thought you were buying at one price becomes significantly more expensive when you follow the full number to the end. Dealerships understand this. Stretching the loan term is one of the most effective ways to make an expensive vehicle feel affordable at the point of sale. A longer loan means lower monthly payments. Lower monthly payments mean the buyer feels comfortable, and a comfortable buyer is far more likely to say yes to the car and to everything that gets added on top of it. This is the first layer of the trap. You're not buying a car. You're buying a monthly number. And those are very different transactions. When you finance a car through a dealership, you're probably not borrowing directly from the dealership. You're borrowing from a bank or lender that the dealership has a relationship with. The dealership submits your application, the lender approves a rate, and then, in many markets, the dealership is allowed to mark that rate up before presenting it to you. The difference between the rate the lender approved and the rate you're offered is kept, in whole or in part, by the dealership as additional profit. This is sometimes called the dealer reserve or finance markup. The exact rules around this vary by country and have been subject to regulation in some markets, but the practice has been widespread enough that regulators in several countries have investigated and in some cases restricted it. What this means practically is that the interest rate you're quoted at a dealership may not be the best rate you qualify for. It may be the best rate, marked up. And because most buyers don't know their own credit profile well enough to challenge it, the markup goes unnoticed. The financing desk at a dealership is not a neutral service. It's a profit center. Understanding that changes how you should approach it. Here's the mechanic that makes car loans uniquely uncomfortable compared to most other debt. Cars lose value fast. A new vehicle can lose a significant portion of its value in the first year alone. The exact figure varies by make, model, and market, but the direction is consistent and well documented. Depreciation doesn't pause while you're paying off the loan. This creates a gap. In the early years of a car loan, especially a long one, you're paying mostly interest, not principal. Your balance is shrinking slowly, but the car's value is dropping quickly. At some point, often sooner than people expect, the loan balance exceeds what the car is actually worth. This is called being underwater or negative equity, and it matters more than most buyers realize at the time of purchase. If you want to sell the car, you can't just walk away even. You have to cover the gap between what the car sells for and what you still owe. If the car is totaled in an accident, your insurance will typically pay out the current market value, not the loan balance. If those numbers don't match, you're still on the hook for the difference unless you had specific gap insurance in place. Negative equity doesn't feel like a problem on a Tuesday when you're driving to work. It becomes a problem the moment your situation changes and you need flexibility the loan doesn't give you. Auto loan terms have stretched significantly over the years. 6-year loans are now common. 7-year loans exist. In some markets, 8-year terms have appeared. The longer the term, the lower the monthly payment, which is why they're attractive. But longer terms come with real costs that aren't obvious at the point of signing. First, interest accumulates over a longer period. Even if the rate is the same, paying over 84 months means paying interest for 84 months. The total interest paid on a long loan can be substantially higher than on a shorter one for the same vehicle. Second, the depreciation to payoff gap gets worse. The longer you're paying down a loan slowly, the longer you're likely to be underwater. A 6 or 7 year loan on a vehicle that depreciates quickly can leave you in negative equity territory for a significant portion of the loan's life. Third, by the time you're done paying, the car is old. You may be making loan payments on a vehicle that needs maintenance and repairs. At that point, you're paying for the car twice, once through the loan and once through the running costs of an aging vehicle. Long loan terms aren't inherently wrong, but they should be understood for what they are: a way to make an expensive purchase feel manageable today by spreading the cost and the risk further into the future. The loan itself isn't the only financial decision you're making at a dealership. By the time you sit down at the finance desk, there's usually a menu of additional products on offer: extended warranties, paint protection, gap insurance, tire and wheel coverage, credit life insurance, various service packages. Some of these products have genuine value. Gap insurance, in particular, can be worth having given the negative equity problem just described. But the issue isn't always whether the product is valuable in principle. It's whether the price is reasonable and whether it's being rolled into the loan. When add-ons are folded into the loan, two things happen. First, you start thinking of them as separate purchases. They disappear into the monthly payment. Second, you pay interest on them for the full length of the loan. A $1,500 extended warranty rolled into a 6-year loan doesn't cost $1,500. It costs $1,500 plus. However, much interest accrues on it over 6 years. This is a quiet but effective way to increase the total cost of a purchase without the buyer fully registering it at the time. One more layer that compounds everything above. When people trade in a car they still owe money on, and that car is underwater, the remaining balance often gets rolled into the new loan. The dealership frames this as a seamless transition. You hand over the keys, you get into a new car, and the old debt just carries over. But what you've actually done is started the new loan already behind. You're borrowing the new vehicle's price plus whatever you still owed on the last one. You're now underwater on the new loan from day one. And if the new loan is also long-term, the cycle begins again. This is sometimes called the trade-in trap or loan stacking. It's one of the ways people find themselves perpetually in car debt, never fully owning a vehicle, always carrying a balance, always making payments. Each trade feels like a fresh start. Financially, it usually isn't. Car loans are not unusually complicated, but they contain several layers that each work in a direction most buyers don't fully account for at the time of purchase. The monthly payment framing obscures the total cost. The dealership financing model isn't neutral. Depreciation moves faster than most loan balances. Long terms extend the exposure. Add-ons inflate the principal quietly. And trade-ins can carry old problems into new loans. None of this means car loans are something to avoid entirely. For most people, they're a practical necessity. But the difference between a car loan that works for you and one that quietly costs you thousands extra usually comes down to a few things: knowing your rate before you walk in, understanding the total cost, not just the monthly payment, being cautious about how long the term runs, and thinking carefully before rolling anything extra into the loan. The car industry is very good making a complex financial transaction feel like a simple lifestyle decision. The monthly payment is the product they're selling you. The car is almost secondary.